Hi everybody, welcome back. Today I want to do a little review of and talk about banking and monetary policy. Remember, monetary policy is the Federal Reserve or the central bank's tools for trying to manage the economy. And that's the idea, is they're going to use their knowledge of banking and the reality of the fractional reserve banking system to use the money supply to alter the larger economy. So we talk about monetary policy because they're using the money supply to change the economy. So, real quick review of how monetary policy works and who does it. We want to remember who controls monetary policy, and that's going to be the central bank, the three tools of monetary policy, the primary tools and how they affect GDP and output, and a little bit of a sense of the review of the banking system and how fractional reserve banking works. And then we want to see how, when we graph this out in aggregate demand and aggregate supply, how it plays out and what the effects are on output, unemployment, and the price level. If you look over here, this is the graphing problem, review problem for banking and monetary policy. The first problem goes through fractional reserve banking. So we're going to start first with this example of depositing $10,000 into a savings account and then assuming that the reserve requirement is 10%. So then figuring out how much can be loaned out and then talking about differences in reserve policy and how those might change. So let's work through this together. The other questions we'll go through are a little bit more straightforward. We're going to ask and answer who controls monetary policy, what the three primary tools of monetary policy are and how they influence GDP and output. And then the last thing we're going to do is graph long-run aggregate supply and aggregate demand and look at using monetary policy tools to enact changes that our economists might want to make. We'll look at that later. For now, I want to go ahead and we can answer this guy right here in the document because it's really just a little bit of a math problem. So if we have a bank, if we deposit $10,000 into a savings account and we can loan out a total of 90% of that, we just need to figure out here the amount that can be loaned out is going to be 90% of those $10,000, or another way to say it is that we can hold in reserve 10%. So what we're going to see is that $9,000 can be loaned out. Well, that's not the word. And $1,000 must be held in reserve. And so remember, we can imagine, it is true, banks can hold excess reserves, but if they want to make as much money as they can, they're going to want to lend out as many, make as many loans as they can and hold the minimum reserves. So that is what that situation is. Now, imagine that, there we go. The bank loans the above amount out to a small business looking to expand. The small business then deposits their loan into their bank so that they can get started buying new equipment. Now, how much money is in the economy? Well, we want to go through and think about this. We started out with $10,000 that was deposited in the bank, but now we have $9,000 loaned out and put into a new bank. So we're going to have a new money supply of $19,000 because that's going to reflect the two amounts. And that's how fractional reserve banking works, right? If we have the original 10,000 is added to the $9,000 loan the bank issued. This is how it works. Right now we have almost, not quite twice as much money. And that's because of that reserve requirement. But that extra $9,000 counts as part of the money supply because someone can deposit that. It can be loaned out again by the second bank. It can be used to buy things. It's money. It has to be paid back. But fractional reserve banking allows us to multiply money through. The next question touches on that same idea. Okay, now if this new bank is only holding the minimum required reserves, how much can they lend out? Well, that's easy. They can lend out they only need to hold 10% of $9,000. Oops, that's not a 10. Meaning they can lend out 9,000 minus 900 or $8,100. So that would then possibly be deposited into another banking account, and that's what we see in this next question. The new bank loans the excess reserves out to a student looking to buy a new car. They deposit it in their account, and now we have $8,000 deposited into the third bank plus the $9,000 deposited into the second bank plus our initial deposit of $10,000 means that we now have in our monetary system a total money supply that's $9,000 plus $10,000 plus $8,100 or $27,100 in total money supply. So now the supply of money in this little miniature economy has grown through fractional reserve banking. Now this is the key here, and this is the part that gets into that money multiplier. How would these answers change if the reserve requirement was doubled? Well, if the reserve requirement doubled, the banks would have to keep more of each deposit, meaning the loans would be smaller at each level. What would that look like? Well, the first $10,000 would only lead to a $10,000 times 0.2, a $2,000 reserve would only leave an $8,000 loan. And then the next $8,000 deposit would only lead to a $7,600 loan. And so already we can see the money supply falling. Now, instead of having 10,000 plus 9,000, a total of $19,000 at the second point, we have 10,000 plus 8,000, only $18,000, and it continues to get smaller because the reserves are higher. So how much banks have to hold on reserve can really control that money supply. So now I'm going to go back to my board and show you some more details on how to answer these next couple of problems, asking about who controls money supply, what the primary tools are, and which part of GDP they influence, and then looking at how we could see the Federal Reserve try to alter the macroeconomy using monetary policy tools like open market operations, reserve requirements, and the federal funds rate. So let's go take a look at that. The main idea here is, again, that the central bank conducts monetary policy. And it all has to do with this, right? The supply of money. The idea that we have some quantity of money, some demand of currency, and some supply of currency. And the price is going to be the interest rate. And we know that the interest rate is the cost of borrowing and the benefit of saving. So if I put $1,000 in a savings account and I earn 2% interest on that, that's the benefit I get of putting that money into this market. into this supply of money. On the other hand, if I go in to take out a loan and the bank says, well, we're going to charge you 5% interest for every month that you don't pay it back, that's going to be the cost of borrowing and being on that demand side. And so what the central bank is going to do with monetary policy is try to either expand the money supply with expansionary monetary policy, which is going to lower interest rates, or contract the money supply with contractionary monetary policy, trying to shrink the supply of money and raise interest rates. And the idea here is that when interest rates are higher, there's going to be less investment spending, and when interest rates are lower, there's going to be more investment spending. And this gets back to that identity that just keeps popping up and it's never going to go away, right? The idea that our GDP or our national productivity or our national output is C plus I plus G plus NX. And we've already talked about fiscal policy, which is when the government is changing consumption with taxes or government spending with government expenditure. But with fiscal policy, we're going to see investment being affected by interest rates, which are determined by the money supply. So it's a little bit more confusing to do monetary policy stuff because there's more steps. It's a little bit indirect. But let's get a review of those monetary policy tools. So it's a 2-board day. Here we go. We've got our 3 main tools of monetary policy. And there are other tools. When we think about the Great Recession, we saw other resources being brought to bear, things like quantitative easing and lots of other things the Federal Reserve and other central banks can do. But these are the 3 big ones that you're going to see come up over and over again in every macro textbook and be talked about on, say, an exam or a quiz or something. And the first one, kind of the most complicated, open market operations. Open market operations are the buying and selling of bonds. And the idea here is that banks have to hold reserves. They hold money in reserve, and that's part of how they protect themselves from risk and financial loss. But when their reserves are in the form of bonds, they can't make loans with those bonds. So they can hold cash reserves or they can hold bond reserves. When the Federal Reserve is buying bonds, that means banks have more money. They'll have more actual cash because the Federal Reserve is taking bonds out of the market and giving cash. On the other hand, when the Federal Reserve is selling bonds, they're going to be taking cash from banks. So banks will have less cash. And they're going to be less able to make loans. So the idea here is maybe I am the world's tiniest bank, and let's say I've got a handy dandy $20 bill here, and this is in my reserves. And while it's a reserve, I can either loan it out or hold it, but I might make a loan with it. If instead, let me make this very quickly, very official. The Federal Reserve sells me a bond for my $20. Now, I don't have those $20. I still have this $20 value in reserve. I'm going to earn interest on it too. But I don't have cash that I can make a loan with. And so it's restriction of the money supply. And that's the big idea here with all of these tools. If the banks have more money, we assume they're going to want to make loans with it because that's a way to earn money on fees and interest when they charge people when they go and make loans, right? If they issue a mortgage, they're going to collect interest on that. And so the more times we give banks cash, the more loans they make, the greater the supply of money, the lower the interest rate, the more the economy churns, expanding the economy. On the other hand, if I am selling bonds to the bank instead of cash, they have less cash to make loans, and so they're going to be issuing fewer loans. There's going to be less money circulating through the economy. Money supply contracts, interest rates go up, aggregate demand shrinks. Hopefully that makes sense. We'll walk through it some more. We'll do some examples. Federal funds rate, similar. What we're looking at here is the rate that the Federal Reserve is going to charge, or any central bank is going to charge. When rates are high, banks borrow less. So they're going to have fewer dollars. When the interest rates are low, banks will have an easier time borrowing. And that's going to mean more dollar bills, which might mean more loans, growing the money supply, expanding the economy, and lowering that interest rate to get investment spending up. So if the federal funds rate is increasing, it's getting more expensive to borrow. We're going to see an increase in interest rates in the market too, and that's going to tend to decrease investment spending and shrink aggregate demand. Reserve requirement is the same. When we see more reserves, a higher percentage of reserves being held, that's going to mean less money to loan out. But when reserves are low, there's going to be more money to loan out, and that's going to expand the economy, lower interest rates, and grow investment spending, growing GDP. So that's the big idea here. Open market operations, we can buy and sell bonds. Federal funds rate can be increased or decreased, and the reserve requirements can be increased or decreased. And the mechanism is that we are going to be either giving banks or trying to encourage banks to hold more cash to grow the money supply by encouraging them to issue loans, or pulling cash out of banks' reserves either by selling bonds, increasing the federal funds rate, or we could be increasing the reserve rate and forcing them to hold more money rather than making a loan. But either way, if there's less cash out there in the system, that reduces the money supply, makes borrowing expensive, and reduces investment spending. Does that kind of make sense? Let's graph it out. So if we come over here and compare our money supply to aggregate demand and aggregate supply, we can kind of see how they are connected. So if we've got our GDP and price level, and we've got long run aggregate supply, aggregate demand, and short run aggregate supply. We can also imagine that over here on the side, we could be looking at the market for money and how that affects this. And so if we've got I'm going to put it in green, supply of money, and the demand for money here, we can do an example. Let's do an example with open market operations. We start out with an economy in some kind of equilibrium with a price level and a level of output and some quantity of money and an equilibrium interest rate. And what we're going to see is that we are worried about inflation in the economy. It's November 2022, and inflation is at 8%, even a little bit higher, and we want to control inflation with open market operations. So remember, open market operations are going to be buying and selling bonds. Can that show up? That does not really show up. Let's do it this way. So we're going to use open market operations. And what we want to do is we want to contract the economy. So if we want to make the economy smaller, shrink aggregate demand, lower the price level, we can kind of think it back logically. To do that, we have to shrink the money supply. And if we want to shrink the money supply, what we're going to do then is we are going to we're going to sell bonds. See, it's confusing. If we sell bonds, then that's going to mean banks have fewer cash reserves. That's going to mean that the supply of money will shift in. And if we shift that curve in, we see that the equilibrium interest rate is going to go up. So that's going to increase interest rates. Increased interest rates are then going to have an effect on our friends over here at y equals c plus I plus g plus nx. Higher interest rates are going to mean less investment spending. I is going to go down, and that's going to mean that aggregate demand shifts in. Aggregate demand is going to shrink because borrowing has gotten more expensive, and that's going to mean a lower level of output, a lower price level, which is good because our goal was to reduce inflation, and it's going to mean higher unemployment. These are the trade-offs, right? There's no silver bullet perfect win. So, open market operations, if we want to shrink the economy, control inflation, we're going to want to sell bonds so that banks hold less cash, make fewer loans. The money supply restricts, interest rates go up. Higher interest rates mean less investment spending, mean lower aggregate demand. Shifting that aggregate demand curve into the left is going to lower output, lower inflation, and increase unemployment. In the next part, I say in the first quarter of 2025, uncertainty is harming GDP. Now we want to do the opposite. We want to expand the economy. We want to grow the economy, but this time we want to use the reserve requirement. And if we want to expand the economy with expansionary monetary policy, we are going to, let's get a new color. You're going to lower reserves. Lower reserve requirements means banks issue more loans. More loans is going to mean the money supply shifts out to a higher level. So the supply of money goes up. The supply of money goes up. We're going to see that interest rate get lower. And that lower interest rate is going to make it easier to borrow, which means firms are going to expand. People are going to start new businesses. This I is going to shift the other direction, because it's gotten more affordable to take out a student loan to grow your education and human capital, start a new business, buy new equipment, and that's going to shift aggregate demand back out. We're going to see output increase, we're going to see the price level increase, and we're going to see unemployment go down. And that's basically how this works. So we can either raise or lower the reserve requirement, we can buy or sell bonds, or we can increase or decrease the federal funds rate, making it easier or harder for banks to borrow. All of these things are going to impact a bank's ability to make loans. More loans, bigger money supply, lower interest rates. Fewer loans, smaller money supply, higher interest rates. Interest rates are going to impact investment spending here and shift aggregate demand. That's the basics of monetary policy.